So I lost around 1.5% in a company called Cochin Shipyard. Let me show you that trade. Same process I have followed as I follow for other trades. So here is the chart of Cochin Shipyard. As you can see, the blue, the green, and the red, the 50-day moving average is above the 150-day moving average, is above the 200-day moving average, and the price is above all the three moving averages, and all the three moving averages are sloping up, which means this is a strong stage 2 uptrending stock. Okay. And I bought on 17th of May, but I did not make money. If you see from here till here, the stock shot up almost 50%. So let me show you. If I take this measuring tool from here, from the yellow line till about here, the stock went up 53%, close to 53% in just 6 or 7 days. That's a fantastic return, but the stock made 53, but I lost 1.5%. How did that happen? Let me explain. First, let me remove these moving averages just to keep the chart simple for you. So if you look at this base, before this breakout candle, which happened on 17th of May, if you look at this base, okay, here is the first point in the base, the high of this candle. Then this is the lowest point in the base, the next lowest point in the base. Then the high of this red candle is the third point in the base, the next highest point, which is below this high. And then this small baby candle, okay, which is the inside candle, the low of that small baby candle is point number 4. So if I zoom in here, so 0.1, 0.2, 0.3, 0.4, and if you count this, this is more than 10 candles in the base. So I am looking for the moving averages to be in my favor. I am looking for 10 candles in the base. I am looking for 4 points in the base from highest to lowest to highest to lowest, minimum 4 points. And then when I have those 4 points, I draw the line at 0.3 or 0.5 or 0.7, whatever is the lowest price that I am getting. I draw a yellow line and I wait for a breakout. Now on this day, I buy when it closes above the yellow line on the 15-minute chart. So let us go to the 15-minute chart, 17th of May. This is 17th of May. So see, this is the first candle of the day, okay? This is 3.67%. If you look at this number, in 15 minutes, in the start of the day, it goes up 3.67%. That itself is a red flag, okay? So if a stock shoots up more than 3% in the first 15 minutes of the day, it could be what I call flash in the pan. Flash in the pan means people who want to buy the stock, they have already finished purchasing the stock, and now there are no more buyers left. So whatever people were holding the stock previous day, they are trying to book profits. That is why you might see this red candle. So in the first candle, after the breakout candle, I did not get a follow through. So I put 5% of my account in this trade. 5% is not a big amount of my portfolio. So I put 5% here, hoping that the stock would go up. But then I waited for 2 candles because my rule for this trade was to wait for 2 candles, wait for half an hour, and then see what happens next and decide accordingly. So if you look at the second candle, the close is below my buying price. The buying price is the close of this candle. I always wait for the close. So since it did not give me a follow through, I just exited the stock. Okay. So from here to here, it's roughly 1.5%. Let's look at that. How much is the loss from this point till the close of this candle? It's 1.42%. I lost 1.42% in about 30 minutes. Okay. But if I had held the stock, because when I buy here, I keep my stop loss at 3%, somewhere in this area. If I had held this stock, then the stock would have gone up. I would have made 52% in about 6 days. Out of 52, obviously we cannot catch the top. Out of 52, even if I catch 40%, that's a fabulous return in just a matter of 4 or 5 days. But the reason why I sold here is because I do sample size trading. And this trade was in the first half of my sample, which means if there are 20 trades in my sample and this trade comes in the first 10, I don't want to risk too much money on this trade. Because if I start losing money when I'm starting a sample, okay, that is not good. The sample will not end well. Sample doesn't mean virtual money trading. Sample means real money trading, but I'm trading in sample sizes of 20 trades. I will take 20 trades, do a post-trade analysis, and then on the basis of that, I will improvise on my next sample. That is how I trade. I don't look at weekly performance or monthly or annual or quarterly performance. I look at performance on a sample and I want to be positive on the sample. So that is the reason why I exited. But imagine if this trade would have been the 19th trade in my sample, and in the first 18 trades, I'm making good money, let's say 1% or 2% of my portfolio. In that case, I would not have sold the stock on the 15-minute chart. I would have waited for the day to close. And when the day closes, I look at the volume. The volume is more than twice the average daily volume. See, the volume is 13 million shares traded on that day. Average volume is 4.7 million. Is more than twice the average daily volume, which is an indication that it's a powerful, strong breakout. The price could go up even further. And then you get two follow-through days. When you get two follow-through days where the closings are subsequently higher, you can be rest assured that the people are accumulating the stock and the stock could potentially go even higher. So with that knowledge in mind, I would have held on to the stock for a longer period of time. That is why I say out of 50%, I could have caught close to 40%, but I missed the chance. If I was making good money in that sample in the first few trades, then I would have held on. But in the first few trades, I had booked small losses. So I had to come out of this trade. So people ask me, Rohit, when should I sell a stock? Well, my answer is it depends. It depends on where you are in the sample. If you have been making money for the last 1 week, then you can give the trade some room to fluctuate. If you have not made money in the last week, you cannot give the trade room to fluctuate because it will hit your stop loss and your losses will expand further. So I hope you understood this trade. Okay, it's the same process that I am using across all my trades. You look at some of my previous videos, recent videos, the exact same procedure has been used on everything that I am discussing here. On some stocks, I make good money. On some stocks, I have to book a loss. That's just the nature of trading. Trading is probabilistic in nature. Now, do I have a regret that I missed this big opportunity? No, because I have seen such things happen so many times that I know this is the nature of the market. The market will first kick me out and then it will go up. Okay, so it's not that the market is betraying me. The fact is, it is just the nature of the market. I just have to accept it the way it is. Okay, so I hope you got value out of this video. So I am at a different location today. I came to Mysore at my sister's place. So that's why I'm recording from here, not from my usual office. But I wanted to make a video for you guys today just to discuss another stock idea. So it's okay to take a loss. It's not a problem, okay? But the loss should be as small as possible, preferably less than 1.5%. If you're consistently booking losses less than 1.5%, and suddenly you get a trade which is like 10, 20% up, you can finance, one trade can finance multiple losses in a row. So your reward to risk actually becomes 5:1 to 10:1. Okay, in reality, if we speak, if you cut your losses short. Anyways, that is what I wanted to share with you. Another stock idea. It's okay to take a loss as long as it is small. Thank you so much.